If you're looking for fireworks in the property market right now, you might be waiting a while. This week, we're looking at a market that's finding its feet but moving at a glacial pace. But I'll tell you why that's great news. We've got some sobering new data on the reality of Kiwi savings accounts and a stark look at how young women are being left behind on the property ladder, and a major bank predicting that 2026 house prices are going absolutely nowhere fast. But it's not all doom and gloom. We're also seeing property asking price drops hit a 2-year low, signalling that market confidence might finally be stabilising. Problems are opportunities in disguise. When you learn how to recognise those hidden opportunities, you too can profit from them. I'm Debbie Roberts, owner and financial advisor here at Property Apprentice. Welcome along to another episode of the Week in Review. Whether you're a struggling saver, a cautious first home buyer, or a landlord weighing up your next move, there's some crucial data to unpack this week. So let's get into it. First up from New Zealand Advisor on the 24th of February, New Zealand landlords brace for rate shocks as tenant power grows. Topic number 2 from RNZ on the 26th of February, young women being left behind in the property market. Topic number 3 from interest.co.nz on the 26th of Feb, ANZ's New Zealand economists see little impetus for house prices to rise this year. Fourth topic from New Zealand Herald on the 24th of February, 1 in 3 Kiwis have less than $500 in savings as people grapple with high costs, a report from Westpac. And fifth topic for this week in review from realestate.co.nz on the 23rd of February, $40 million wiped from the property market in quarter 4. So first up for this week in review from New Zealand Advisor on the 24th of February, New Zealand landlords brace for rate shocks as tenant power grows. Our first topic looks at the latest Crocker's Property Management Tony Alexander Investor Insight Survey, which shows that New Zealand residential landlords are becoming increasingly anxious. Despite a dovish turn from the Reserve Bank and an improving economic outlook, worries about rising interest rates and upcoming tenant legislation are starting to trend upward. Investor demand to expand portfolios remains incredibly soft. Only 16% of respondents plan to buy another property in the next 12 months, tying with January as one of the weakest outcomes in the survey's 5-year history. Meanwhile, a net 17% of existing investors are actually planning to sell, partly driven by an ageing cohort of landlords cashing in to fund their retirement. The rental market also remains heavily tilted in favour of renters, which isn't necessarily a bad thing, just saying. A net 30% of investors report difficulty finding good tenants, largely due to below average population growth and a high supply of unsold developers' properties entering the rental pool. Despite this tenant-friendly backdrop, a net 44% of landlords still plan to raise their rents over the next 12 months by an average of 4%. However, the survey warns that actually achieving these hikes might be difficult, given the current high supply of rentals in some areas. Interestingly, bank financing is not seen as a major hurdle right now. Instead, landlords are far more worried about cost pressures like insurance and council rates, alongside the looming risk of policy changes as the next election approaches. So my thoughts on this are, if you're in the market to be looking at investing in property, this is literally an ideal time. When everyone else is sitting on their hands, that gives you the opportunity to negotiate harder on the asking price and get yourself a really good deal. With rents that have softened in a lot of different areas, doesn't mean that it's hard to find good tenants everywhere. So as long as you know the area that you're investing in and you understand tenant demand and all that sort of stuff, the risk is reduced for you as an investor. So my thoughts on this are, with bank lending criteria really friendly and plenty of properties available for sale at the moment with not that much competition from other buyers, if you miss this window of opportunity, you're likely to look back with regret. Topic number 2 from RNZ on the 26th of February, young women being left behind in the property market. Our second topic highlights a stark ownership gap, which is quite shocking. Cotality's latest report, Women in Property, reveals a significant gender divide in home ownership, particularly among younger New Zealanders. Over 50% of Gen Z males and 66% of millennial males own the home that they live in, compared to just 33% of Gen Z females and 37% of millennial females. This gap extends to property investment too, despite 62% of women considering property ownership to be very important, compared to 54% of men. So what's driving this? Systemic financial barriers, primarily income disparities, are a major hurdle. The less you earn, the less you can borrow. The survey found that 25% of men earn at least $100,000 a year, compared to just 12% of women. Beyond wages, there's a clear knowledge gap, which I find offensive. It's 16% of women reported they haven't bought property yet simply because they didn't know where to start, compared to only 6% of men. Experts suggest earlier educational initiatives focused on finance could help bridge this gap, allowing more women to build the equity, stability, and security that they highly prioritise. So, to all of you women that are listening to this podcast, there's hope out there. Come along to one of our free events and learn a bit more about the fundamentals of investing in property, because property really is the best pathway to create financial security. You can't rely on men to, what's that old saying? A man is not a financial plan. Get your own financial plan, create your own wealth, even if you're single. There's more than one way to get on the property ladder. So, join me at one of our free events and I'll give you a few tips. And if you become a client of ours, we'll work with you to help you reach your long-term goals and reduce the risk for you. We can be your sounding board. If you don't have someone else that you can bounce ideas off, let us help you with that. Topic number 3 from interest.co.nz on the 26th of February. ANZ New Zealand economists see little impetus for house prices to rise this year. The country's largest home lender reports that the 2026 housing market has kicked off with a fizzle. While there are positive economic signs like normalising consumer confidence and a tentative rise in net migration, these are being neutralised by high housing supply, election year uncertainty, and the prospect that the next official cash rate move will be up rather than down. As a result, ANZ recently downgraded their 2026 house price inflation forecast from 5% to just 2%, warning that it could drop even lower. A major factor keeping prices stagnant is that long-term mortgage rates remain high compared to current rental yields, removing the incentive for investors to push prices up, which again I find offensive because investors that know what they're doing don't push prices up. If anything, we're the reason for prices coming down because we negotiate like the thunder. For borrowers looking to refix, however, ANZ suggests considering a short-term fix, like 6 months to ride out the current rates, but warns that this is a risky strategy if the economic recovery accelerates and rates jump sooner than expected. My thoughts on this, as I seem to be saying, I'm starting to sound like a broken record now. Talk to your mortgage advisor before you make decisions about whatever to do with your fixed rates, because this could be a good opportunity for you to split your mortgage to reduce your risk. You might fix part of it for 6 months or whatever, and another part of it you might choose to fix for a longer period to take advantage of the fact that interest rates are still below average, even though they are increasing or expected to increase towards the end of this year, if not sooner. If you're getting value out of this podcast, please open your Apple Podcasts or Spotify app right now and hit the follow button. It's the number one way to help us reach more property investors in New Zealand and to help them. Fourth topic for this week in review from the New Zealand Herald on the 24th of February. 1 in 3 Kiwis have less than $500 in savings as people grapple with high costs, according to Westpac. New data from Westpac reveals that 36% of New Zealanders have got a savings balance under $500. Furthermore, only a quarter, 25% of people, are making monthly automatic payments into their savings accounts. The national median savings balance currently sits at $2,700. Tom Hartman from Sorted expressed concern over the figures, emphasising that an emergency buffer is essential. Without it, individuals facing unexpected life events are at high risk of falling into crisis borrowing. While high living costs make saving difficult, many are intentionally channeling extra cash into paying down their home loans. Still, 81% of Westpac home loan customers maintain a savings account, though only 36% of them have set up automatic transfers. Continuing the recent Tale of Two Islands theme, Canterbury and Otago are the country's best savers. Both regions boast a median savings balance of $4,200, with 32% of customers holding over $15,000 in savings. At the other end of the spectrum, Aucklanders have got the lowest median savings at just $1,200, with a staggering 43% of Aucklanders holding less than $500. Westpac notes that the significantly higher cost of living in the super city is directly reflected in these numbers. When it comes to retirement savings, Wellington and Southland tied for first place, with 42% of Westpac customers holding KiwiSaver balances of over $40,000, which, 40 grand isn't going to be enough to fund a comfortable retirement. Overall, 38% of the country meets this threshold, prompting experts to remind Kiwis to ensure that they're in the correct fund for their life stage. As a KiwiSaver advisor, I can't emphasise the importance of this enough. All of our clients at Property Apprentice get advice around their KiwiSaver and other investments, as well as property investing and mortgage management and cash management. This is such an important tool and useful information to help you on your journey towards getting a stronger financial future. First topic for this week in review from realestate.co.nz on the 23rd of February, $40 million wiped from the property market in quarter four. Finally, we have some green shoots indicating that the intense repricing we saw last year might be starting to ease. According to realestate.co.nz, property asking price reductions hit a 2-year low in the final quarter of 2025. Only 1,374 listings recorded a price drop, representing just 3% of all listings, which is a complete turnaround from recent times. The total value slashed from asking prices was $41.3 million, which is a significant decrease from the $55 million dropped in quarter four of 2024. Vanessa Williams from realestate.co.nz noted that this decline isn't because of smaller individual discounts, but rather fewer properties needing to reduce their prices overall. This indicates that sellers are pricing more realistically from the outset, and that buyer confidence is slowly returning to the market. Combined with a stable official cash rate, experts view this as an encouraging early sign that the market could hit its stride later in 2026. My thoughts on this are, we've got business confidence at a 30-year high at the moment, not just in our business, but businesses generally. Recent surveys have shown that. And when businesses are confident in the future, that helps trickle down as far as, they're more likely to employ new staff, and business growth helps people to get pay rises and all of that sort of stuff, which helps make people more comfortable with their financial position and more likely to spend in the economy, which will help improve the economy overall. So the verdict for this week, if you're listening to today's podcast and feeling a little bit overwhelmed, I want you to know that you're absolutely not alone. Hearing that over a third of Kiwis have got less than $500 in savings, or seeing how many young people feel completely locked out of home ownership, it's really tough. It's really tough to hear and to read. It's been an incredibly hard few years. And whether you're trying to scrape together a deposit, struggling to pay high rent, even though rent is the most affordable it's been for a long time, or if you're a landlord stressed about rising costs and decreasing rents in some areas in the country, the pressure right now is really real. But I also want to remind you that even in a flat, cautious market like this, there's always a path forward. there's opportunities if you know how to look for them and you know how to spot those opportunities. The fact that property asking prices are finally stabilising shows us that the ground's firming up beneath us, which means that we're entering that early phase of the property market recovery. We don't know how quick it's going to be or how long it might last, but house price rises are much more likely in the future than further decreases. You don't have to figure all of this out on your own, and you certainly don't have to just cross your fingers and hope for the best. If you're ready to take a breath and start working towards building a plan that actually works for your unique situation, I'd love to invite you to one of our free online masterclasses called How to Succeed with Property Investing. During these live sessions, I cut through the intimidating jargon and I'll walk you through how to spot the right opportunities, how to protect your cash flow, and how to build a more resilient financial future step by step. We're 100% independent, which means we're a New Zealand-owned, family-operated business, and we don't sell property. And so you can trust that the advice that we provide is completely unbiased and focused entirely on what's best for you. We don't just give financial advice about property investing, we cover the whole shebang. So head over to propertyapprentice.co.nz and register for one of our free events today. We do them once a week, most weeks of the year. If you've already joined one of our free events and you're ready to become a lifetime coaching program member, you can also book a no obligation meeting or phone call with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Hang in there, peeps. Keep taking those small steps forward, and I'll look forward to seeing you next week. Thanks for listening. Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.